Parag Parikh Mutual Fund is launching a new large cap NFO, and I'm here to explain it in very simple and clear words. Hi everyone, I'm Sneha Vasudev, your certified financial planner, and yes, I'm SEBI registered. This video will be a little different from the ones that you've been seeing online because I just won't read that PDF. First, I'll explain the fund strategy in very simple words so you understand how it will actually invest. Then I'll start with few details from recent interviews of Mr. Ronak and Rajiv Thakkar so you can actually understand their market outlook and know where the fund may head. After that, I'll explain how this fund is different from their Flexi Cap Fund, and finally we'll go through few key points from that PDF. So this fund is basically like Nifty 100 index fund, but it uses few smart moves to earn a little extra. For example, sometimes stock futures trade cheaper than the actual stock, like during a market crash, when many futures trade at a discount because traders avoid taking cash delivery. So the fund could buy cheaper futures instead of stocks. Another example is when Nifty futures trade at a discount to Nifty index, which happens during volatile days. So the fund could benefit from cheaper futures and gain that edge. The fund also takes advantage of corporate actions like mergers and acquisitions. For example, when HDFC Bank and HDFC Limited merged, HDFC Limited was actually trading at a discount to the bank. And finally, when a stock is added or removed from the index, like Bajaj Housing Finance was added to Nifty 100 and Adani Total Gas was removed. ETFs usually trade only on the day of the change, but the price often starts moving way earlier. So this fund tries to capture that early move. I was listening to recent interviews of Mr. Ronak and Rajiv Thakkar, and the main thing that stood out was how calm and disciplined they both are. Mr. Ronak believes that the market is still not very cheap, which is why they've been holding cash for a very long time, for around a year, around 23 to 24%, and are investing very slowly. The cash is parked in safe instruments like CDs and short-term debt. On the tech side, they hold IT Indian companies like TCS, Infosys, and global names like Microsoft and Alphabet. He thinks AI will change things, but IT services will still be needed because enterprise systems are complex. He also sees EVs as a long-term story and believes debt and REITs can be a good option for balance. Mr. Rajiv Thakkar's message is really simple. He says that first decide if you are a passive or an active investor. If you are a passive investor, stick to broad-based indices like Nifty 50 or S&P 500. If you are an active investor, you must trust the fund houses and the fund manager for long term. He says diversification doesn't mean holding many funds. It means having the right asset allocation. He prefers diversified funds over sector or thematic funds for most people. He also warns against reacting to recent winners and suggests automating investments through SIPs and rebalancing. His final advice is classic. Be greedy when others are fearful and fearful when others are greedy. Both of them basically say the same thing. Calm valuation-based investing over time works best. Okay, a quick disclaimer. We onboard clients only after a one-on-one consultation, which you can book through the link I mentioned below. Our stock portfolios, mutual fund portfolios, and training programs are not available anywhere for direct subscription. Access is only given after a personal meeting with me. So please do not give your money to anyone claiming to collect fees on our behalf. We also do not run any free Telegram channel. The only Telegram channel we have is a purely paid educational channel, which is called Sneha's Wealth Learning Network, priced at $3.99 on our website. The main difference between these two strategies is that the large cap fund is basically following the Nifty 100 index, whereas the Flexi Cap Fund is choosing stocks based on what it believes will grow the most over a long period of time. The large cap strategy sticks to big well-known companies and tries to earn little extra through smart moves like buying cheaper futures or taking advantage of corporate events and index inclusions and exclusions. In contrast, the Flexi Cap Fund doesn't really care about index rules and can invest across large, mid, and small caps, focusing on quality businesses and holding them for years rather than reacting to short-term market trends. However, I have the list of all the stocks that the Flexi Cap Fund is actually investing in, and I'm trying to figure out how much overlap it can have with the large cap NFO. Most of these stocks in the Flexi Cap Fund are large cap companies that are a part of Nifty 100 index. So a typical large cap fund that follows the Nifty 100 would naturally have these stocks. Almost 70 to 80% of the flexi cap equity stocks are in Nifty 100, while the remaining 20 to 30 are either small cap companies or large cap companies that are not in that index. So if you're investing in the Nifty 100 styled large cap fund, there is a higher chance, around 50 to 60%, that it will overlap with the existing portfolio. But the rest of your holding will be different because they're not index linked. Parag Parikh Large Cap Fund is basically designed to give investors clean, low-cost exposure to India's biggest companies without trying to be flashy or overly smart. The fund invests in top 100 companies through Nifty 100 index, which gives much broader diversification compared to Sensex and Nifty 50. For example, Sensex has just 30 stocks, Nifty has 50 stocks, while Nifty 100 captures many more market leaders across sectors like banks, IT, FMCG, metal, pharma, covering much larger of India's profit pool. The core idea is not aggressive outperformance, but it is staying close to the index while reducing hidden costs that usually eat into the returns, like frequent trading and poor execution. So stock selection itself is completely rule based here. If a company is a part of Nifty 100, it's included, right? But with a cap of 10% per stock. So even giants like Reliance or HDFC Bank cannot actually dominate the entire portfolio. Where the fund manager actually adds value here, it is not about stock picking, but implementation of the portfolio smartly. Important part is smarter rebalancing. Index changes are announced in advance, but index funds buy and sell exactly on the rebalancing date, which pushes the price up and down. Imagine everyone is rushing to buy the same stock on the same day, but this fund instead, places its order over time to avoid crowded trades. There is just one goal here: to minimize execution cost and improve net returns without changing the portfolio's core nature. On the top of that, the expense ratio they're trying to keep very low with a very low churn cost. This fund is ideal for investors who want stable, diversified exposure to India's large cap companies and who prefer lower cost over excitement and are okay with index like returns, and also who have a long term horizon of 5 years to 7 years and above. It's not meant for those investors who are looking for aggressive alpha, concentrated bets, valuation based stock picking, or short term gains. Overall, it's a very disciplined, boring by design, focused, diversified fund with cost control. So do your own research because mutual funds are subject to market risk. Read all scheme related documents carefully.